Alright, what I'm going to demonstrate here is how to record a notes receivable, which is an asset on the balance sheet. And this notes receivable will be for one payment here at the end of the fourth year. So, at the beginning of the first year, we either loaned something or sold something here and it had a present value of a certain amount. And then at the end of the fourth year, we actually received payment for that item that we sold or loaned at the beginning of the first year. So, associated with that notes receivable here will be a discount to the notes receivable, and then we're going to look at the notes receivable revenue. So we'll have to determine the present value of the notes receivable here at the beginning of year one, and then interest payments that we receive on the notes receivable. And these interest payments are going to be based on the future value at the end of the fourth year, or the amount we receive for the notes receivable minus its present value at the beginning of the first year. And then the difference here is the interest revenue that we would earn on that notes receivable. And then this interest revenue has to be allocated to the notes receivable revenues here. Now, before we go ahead, we have to make our determination here on what interest we would allocate here for that notes receivable, and we also have to go in and determine the present value. So let's go on here and we'll go through the mechanics of doing that. Alright, here we have to determine our interest revenue for each of the next 4 years. And in order to do that, we have to know what the beginning balances of our notes receivable is, or its present value, at the beginning of year one, and we have to know the interest rate. So let's go up here and just look at our cash flow diagram. Okay, we're going to receive, in this case, $4,000 at the end of the fourth year, and then knowing the interest rate, we discount that back to determine its present value. So we do that here with a present value function either in your calculator or an Excel function here. So you got the rate, number of periods, and in this case it would be a future value payment here. Alright, let's take the case here where we don't know what our interest rate is, and we have to discount this $4,000 back, but we don't know the interest rate. So in that case we'd have to know what the present value is, and we'd be able to determine that at the beginning of year one. And then we know that we're going to get a $4,000 payment here at the end of year 4. So what we do is we go in and we determine the interest rate using the internal rate of return function, either in Excel or using your calculator. And then here we would determine what the interest rate is, and then we'd be able to apply it here. So in either case, we would have to determine our interest expense in this fashion. So we determine what our present value is. That would be the beginning balance of the notes receivable at the beginning of year one, and then we know our interest rate, so we'd multiply our interest rate times that beginning balance, and then we get the interest revenue for the beginning of year one. Then we'd add those beginning balance to the interest revenue, and then we'd subtract the payment. Well, we're not getting a payment here, so our ending balance would be, in this case, $3,005. So we take that ending balance of year one, and it becomes the beginning balance of year two. So then again we go through the same mechanics. We take the interest rate times the beginning balance, and we get our interest revenue. So then we add the beginning balance, the interest revenue, and we get the ending balance for year 2. So we go through the same mechanics for years 3 and years 4. But looking at year 4 here, we had a beginning balance of $36.36 plus an interest revenue of $364. You add those two together and you have $4,000. Then you subtract out the payment we're going to receive at the end of the 4th year, which is $4,000, so our ending balance would be 0. Alright, so we've determined here our present value and our interest revenue for each of the next 4 years. Alright, let's look at how we would record this notes receivable, which is an asset on our balance sheet. So at the beginning of the 1st year, we had $4,000 debit entry to notes receivable, or we increased it by $4,000. and then at the end of the 4th year we receive payment on a notes receivable. So we credited notes receivable, reduced it by $4,000, and then we debited our cash, or we increased our cash for $4,000 for the payment that we received. All right, let's go over here and look at our notes receivable revenues. So at the beginning of year 1, we recorded the notes receivable present value here of $27.32, and then for each of the next 4 years we recorded our interest revenue on that notes receivable. So if we take our present value here that we recorded in year 1 plus our interest revenue for each year and add them together, we're going to get a $4,000 total here, which is our balance for the notes receivable. All right, let's go down and look at our discount revenue, our discount on our notes receivable. So this discount here is a contra account to our notes receivable. So let's first look at how we calculated it here. So we increased our discount on notes receivable by $1,268, and that we calculated here by we knew what the future value on our notes receivable would be. It was that $4,000 payment less the present value of the notes receivable, and that equaled our discount here of $1,268. So let's just see how that discount works. So at the beginning of the 1st year we recorded the $4,000 debit entry to the notes receivable, and then the associated credit entry here on notes receivable revenues was $2,732. So what we needed is a balancing credit entry here, and that would be the discount on notes receivable for $1,268. So for each of the next 4 years, our interest revenue that we earn on a notes receivable would reduce this discount. So at the end of the 4th year, we have a $1,268 credit balance, $1,268 debit here, so we have a zero discount. Our discount on notes receivable would have a zero balance. But if we look at our debit entry here, reducing the discount on notes receivable, that debit entry would be the credit entry, or the increase in our revenues on those the interest received. So that would be our credit entries here for each of the interest earned for each of the next 4 years. So in summary here, we received our $4,000 payment at the end of the 4th year. We discounted that back to its present value at the beginning of the 1st year, and then we subtracted the two, and we come out with the interest revenue that we'd earn on the notes receivable, and then we allocated that to our notes receivable revenues for each year. So that's just a summary of how we'd handle a notes receivable with a lump sum payment at the end of the term, or the end when we receive that notes receivable.